Welcome back to the Capital Mindset Show, everyone. Hope you guys are having a great day as always. Today we're going to be talking about Disney as well as the 6.3% gain they actually had today. So why do they have this gain? Well, we take a look at CNBC over here. Disney blindsided Chapek with CEO decision after reaching out to Iger on Friday. So it appears that Chapek had no idea what was going on. So basically, Iger is now back in, Chapek is gone. Chapek is the former CEO, Iger is the CEO before him, and now we're seeing this basically power shift to kind of akin to the change in strategy. Why might this be? Well, let's take a look at the price action of the stock. Investors are probably not too happy. The stock has literally gone nowhere in the past 5 years, and if we max out this chart, it has gone nowhere since about 2015. It's actually down 17.94% from the top of 2015. Now, with that being said, that is not indicative of where the company's going into the future. I also don't want to talk too good about Iger. Iger did do the acquisition of Lucasfilms, as well as kind of build what Disney is today into this massive conglomerate. But going forward, what is the company planning on doing in order to maximize the potential profits that the business can generate? Well, we'll see. It appears that they're kind of, or the last CEO, the former CEO, Chapek's decision was to kind of raise prices as it regards to the actual parks. We'll take a look at the park segment within the 10Q, as well as their other businesses, and we'll kind of see how that's kind of not doing so well. It actually is recovering. No, it actually is recovering, but it's not the most sexy part of their business, to say the least. So let's go over to the 10Q and actually get through some of this data here. I want to show you the sales segment. So we do see that the services segment, which includes parks, has actually risen nicely from the previous year or same time last year. And we do also see from the 9-month period is also recovering. Remember, the context of 2021 is, of course, that they have the pandemic. So keep that in mind there. I wanted to show you the most recent actual report from the quarter, and I want to take you to this page here showing you the different subscription segments. We have Disney Plus actually still growing domestically 20%. International, it grew 57%. Disney Plus Core as a total is, or Disney Plus Core 2. Yeah. We also have Total Disney. Total Disney grew at 39%, and then ESPN Plus, they're down at the bottom at 42%. Then we have Hulu, Live TV, but basically total Hulu grew at about 8%. So when you combine everything together, we see this massive platform, robust platform with very many options as far as consumers go. I think maybe it's a little bit too confusing. I don't think they own the entirety of Hulu yet, but if they did, because I think they own the vast majority of it, if they do own the whole thing, I think they should actually consolidate it into one platform, make it very simple for everyone, and even actually put in ESPN into the mix. Well, maybe actually keep ESPN Plus separate, because I think that's, not everyone wants that. Some people want just what's on Disney Plus. Some people just want on ESPN. But I think Hulu makes it a little bit more confusing. So if we actually do see the average monthly revenue per paid subscriber, this is an important metric. It's what's something we would pay attention to Netflix as well when we were investing in Netflix. And here we see that domestically, the United States and Canada, we do see a drawdown from $6.81 to $6.10. So this is not good news, to say the least. With the drawdown that we saw in the earnings, and actually I want to comment on that. We go back to the 1 month. We do see upon earnings, they actually fell 13.16%. This was one of the dark spots of the earnings report. International, it did grow by 4%, but again, domestic is the most lucrative portion right now. And again, going down the list, you see ESPN Plus actually rose by 2% and Hulu down 4%, but not too much. The real hitter was domestic, US, Canada, Disney Plus. So if we go down to some other line items here, I want to take you to the income statement for this quarter. We do see revenue, again, kind of trending on the same story, rising from the previous year, but just not as much. Growth slowed down a bit below the expectations of what analysts were expecting. And so, of course, the stock got punished. Now, this is, again, cause for concern by the board of directors as well as various shareholders, and so kind of explains why the old CEO is losing his job. Of course, with a very generous exit package. Let's not kid ourselves there. And Bob Iger is coming back at the helm of the company. Now, we do see, again, kind of the same theme from the previous quarter's earnings. The October 1st, 2022, October 1st, 2021, we do see recovery. Context is still recovering from COVID-19. And we talked about that when we went over Disney's earnings, or as a question during the live stream. So it's basically on its recovery path, but still not there. Definitely not eking out a ton of profits, as you can see down below in the earnings per share. As far as net income goes, the company's just not making as much money as it once was. For those of you who have been investing in the stock market, this is about 2018 at the very minimum. You remember that back in those days, Disney was actually generating close to $10 billion in free cash flow per year. Now, this begs the question of the strategy that Disney has asked for or gone. Maybe Disney Plus, do you think that's actually the way they should have gone, or maybe a more royalty-driven agreement? I'd love to know your thoughts down in the comment section below. I'll kind of give my thoughts on both sides. So one side says, well, the other side, they can focus on the content only and then give it out to other platforms, not worry too much about hosting the platform and just make money that way. The other side says, well, they want to control the full experience of the consumer. And in doing so and allowing these other platforms to kind of host their content, they're allowing them to grow and potentially eventually strong arm them. And they want access to, again, the full experience of the consumer, from the resorts that they go to at the hotels or the parks, from the actual dining experience, from the movies, etc. Everything entertainment, they want to be there for you, the customer, and Disney Plus is one way of doing so. So going over to some other parts, I want to show you the balance sheet real quick. So we do see cash and cash equivalents is coming down from the previous year to 11.6 billion. A bit concerning when you consider that the debt pile has actually grown. This is not the same company that you were investing in 2018. In fact, Bob Iger actually saw to it himself personally. I joke. But the debt pile has grown tremendously as the company has been investing in content and the parks, etc. The parks, actually, that's a question mark on that because I don't really see any improvements there. But all in all, the company has been trying to invest in itself for the future. That's the buzzword there. And of course, every company is going to say that. But Disney in particular, I don't really see where the return on investment is going to be coming from. That's just a little bit of a glance there. Now, I want to highlight something. Do you see this line item, parks, resorts, and other property attractions, accumulated depreciation? So remember that this is the book value. So that's the attraction, building, and equipment. And the total value, so to speak, is that $27 billion figure. So that's the book value because that's after the accumulated depreciation. Keep in mind that you would add back the accumulated depreciation to get to the $66 billion. Warren Buffett once upon a time bought Disney for below replacement value. That's not still technically replacement value because you have to account for what those assets would account for today. So that's actually true replacement value, a bit more complicated to calculate, but all in all, it does appear as though, this company, of course, has a lot of assets, a lot of physical assets, projects in progress, and land also account for there as well. Goodwill, they have made a tremendous amount of acquisitions in the form of Fox, Lucasfilms, Marvel. All of these businesses together, kind of what they overpay for in their measures goes into that goodwill line item. So keep that in mind. Now we take a look at the long-term liabilities. We do see that the debt pile is still at 45 billion. It is coming down, so they are paying down the debt. But remember, again, I'm going to repeat it one more time. This is not the Disney of 2018 that you were investing in if you've been a shareholder since then. This is a much more leveraged version of Disney than back then. Doesn't make as much cash flow, doesn't make as much earnings for now, and the hope is that they'll get back to that. Now again, if you go to the statement of cash flows, we do see that the cash flows, they are actually producing a positive cash flow return right now. So year end October 1st, 2022, October 2nd, 2021. We do see that in both years they are technically cash flow positive when you consider the amount of cash flows they generate from operations as well as what they're investing back into the actual resorts, etc. So all that being said, we have to kind of determine from now, is it a good time to buy Disney? Well, we do see that historically this has actually been the time to accumulate Disney shares. And so and remember, go back to my channel, go see the original videos on Disney. I was not positive on this stock. I did not think the stock was a good value. Now, the company has come down significantly from prices we talked about it before. Now is a time to maybe start to question, is it a time to buy? Is it a time to accumulate? I will tell you, historically, this has been around the price point in which you would probably want to think about it. And so I'm going to be doing exactly that. I'm going to be thinking about buying Disney at these levels and potentially adding it to my portfolio, kind of being aware at the same time that I don't want too much exposure to this space, and I've already chosen basically my winner for this space, which is Netflix. So that being said, let's take a look at some valuations, and we're going to kind of see what's going on. So I made some changes, and some of them you might actually notice off the top of your eye, but basically I created some new tools to help me out here, and I'm still going to be adding some more tools for myself to kind of help me through this process. So right now, ignore everything. I haven't put any actual, projections or growth rates yet. Now, one of the things I want to highlight to you guys is showing you the cash flow. So analysts are actually estimating the cash flows to recover significantly as the company is investing a ton of cash flows back into the business for now. So going forward, they're not going to be doing so much of that. At least that's where the projections go. The revenue estimates are basically tamed a little bit down from the previous year going forward. And then we also look at the kind of sad and pitiful shares outstanding. All those buybacks they did were kind of wasted and then brought back. So they're basically back to where they were before. Again, the risk inherent with buybacks is that you basically bought them at terrible prices. Of course, the share issuances appear to be at favorable prices. So I'll actually give Disney the benefit of the doubt here that the average price that they did issue the shares at were at higher prices than they are today, which means they probably got a lot more money than, let's say if they started issuing it today, right now. So thankfully, let's just hope for the best on that front. All right, so kind of going over some of these other parts of the business, we do see that the expectation or the average growth over the past couple years is penciling in around 88%. This is, again, because of the fluctuations of the cash flow, so ignore that. That's not actually true. And what we're going to have to do is kind of pencil out where the estimates are going to be. So we're going to start from that base here, and then we're going to say yes. We're going to say year 2. And then we're going to max it out on the estimates at 14.61. So I think that's fair. We're going to start from this base here. Ignore the highest growth rates. Ignore that. We're probably going to see more timid growth from Disney as, again, they kind of get to that recovery point. But at that point in time, they're going to kind of grow at an anemic pace. They're not going to be growing crazy amounts. Of course, the auto DCF is coming in at about a fair value of $106. It is technically below that. If you just want to use what the, let's be fancy and call it an AI says, well, there you go. I'm not going to be doing that. I'm going to be kind of being a little bit more nuanced with my approach here. And I'm going to say, of course, a bit higher growth there and kind of penciling out what I would be having to expect. Now, if I'm going to be a bit more conservative in my approach, I'm going to say I'm not going to include buyback or dilution. I'm just going to leave it flat like that. And then in terms of the actual margin safety, considering where we are at, I would actually say that something like Disney would have a discount rate. I kind of penciled it out to be around personally 12.5, 13%. I would say going any lower is a bit too much for Disney. Definitely not. And then going too high is a bit inappropriate considering where, again, we're at. If you kind of notice how we've kind of projected throughout time, these things do change over time depending on, of course, where I think things are headed currently. So 12% is where I'm kind of penciling out right now. Of course, I'll kind of show with a different percentage there. But in terms of growth, ignore the 20%. I don't think that's even possible. So I think on the high end, we're going to see maybe, let's go like on high end 12%. So high end 12%, that's me being pretty aggressive in that case. And we're seeing, fairly good prospects here and there. If I have to expect a lower growth rate, you can see that, I can't really be interested in investing in this company. Now, if I wanted an even greater margin of safety, I'm going to have to be patient and avoid the stock for now. Why would you want a greater margin of safety? Well, we talked about in previous live streams a hidden scandal, a potential grenade in their hands. And it's something similar, if not this, well, it's more similar to the waste management scandal back in the day. So if you guys don't know what I'm talking about, I implore you to look it up. And it has to do with the whistleblower who actually came out from Disney and is basically making claims that the company overstated their revenues, which is a bit problematic if proven to be true. Problematic is actually an understatement. It would actually be devastating to the share price in the short term. And that would be at the point in time where I would actually think about accumulating shares. If I think the company's, of course, not going to die and the discount's probably going to be quite extreme. As far as the debt profile of Disney, it's a bit concerning to me. They did issue a ton of debt at very favorable rates. I'll say that, okay? Very favorable rates. And to be honest, if I'm looking at it from that perspective, I don't think the debt's too much of a risk. However, I would prefer it to be less leveraged than it currently is. And I see that they are paying it down, so I'll give them that. Again, historically, this has been the price range where people have been doing well at accumulating the shares. Now, you might be more bullish on Disney than I am in terms of where they're going to grow, how they're going to grow, all the different IP brands that they do have, and you think that they're going to excel in actually unlocking value from these brands, making sure that people still are falling in love with the content and then desiring to go to the parks, watching the movies, all of this, and they can generate revenue all across the board, and then that they don't squander their ESPN platform and it becomes the go-to place for people to watch sports. It is a very competitive space. I am almost kind of weary about it because I know how bloated Disney is as a company, and all that entails when they're competing against lean machines like Netflix, Amazon, Apple TV. Even Warner Brothers Discovery is actually producing excellent content in regards to Disney. If you actually go and check out the actual content from Disney and the rankings, it's actually a rather sad and I don't really even know what to tell you guys. So basically, Netflix is almost consistently dominating the top 10 shows. So we have The Watcher, School for Good and Evil, House of the Dragon from HBO Max. We used to have a while ago, just the other day, what was on here was Rings of Power from Amazon. But you continue to go down. Netflix. Now Netflix doesn't make the blacklist or NCIS, but on Netflix, this is where people are watching it the most. Gilmore Girls, and then the other ones. Love Is Blind. Netflix is making some really good reality television, and reality television is cheaper to make, but so basically has a good return on investment. Something that Discovery Plus really understood back in the day, and still they understand it. And then Unsolved Mysteries 2020. So. Again, The Watcher, by the way, is a very good show. Very good show. And then what was on here before was Dahmer. So Dahmer was actually at the number 1 just the other day. But House of the Dragon has really maintained that spot. But again, what you don't see on here is Disney. Now, if we go to movies, Disney should have something here. So we have Disney Plus, Disney Plus, Disney Plus. So we have 3 Disney Plus movies with The Nightmare Before Christmas. Now, what's funny about that is that's a very old movie. This is kind of showing you the strength of their brands. It's because we're in season. We just went through Halloween, of course, and we're about to enter Christmas because it's kind of a dual movie. It's a Christmas and a Halloween movie. We also see Hocus Pocus 2 and Encanto right there. So, but Netflix still has The School of Good and Evil, The Curse of Bridge Hollow. So the top 2 are still Netflix, and then we have the top 5, or in the top 5, we have 3 that are Netflix, which is crazy. And then again, Netflix. So just to show you again, I've made my choice in terms of what I'm investing in this space, and that is Netflix. Would I be considering adding Disney? Absolutely. I mean, at the right price, of course, I'd add Disney. And then we can see, let's say, original content. Again, Netflix. Do I need to show anything else, guys? All this Netflix, and then we have Rings of Power, and then whoa, sorry, we do have a Disney Plus on the top 10 at the 9 spot, and technically Hulu. So we have 2. Let's give it to them. We have 2 at the top 10. 9 and 10 are occupied by Andor and The Handmaid's Tale. I'm interested in doing further research on Disney. I'm interested in at least putting it on my watch list and kind of watching as things progress from here. Whether or not I add to it will depend on the price that I get for Disney. And I hope you guys enjoyed this episode on Capital Mindset. If you guys enjoyed this episode, feel free to leave a like if you so choose. Comment down below. It helps the channel grow a lot. And also subscribe if you're not actually already subscribed if you want to see more content like this. With that being said, I'll see you guys in the next one.